Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Carnival has been on an incredible run over just the last couple of weeks. The stock has nearly doubled in value, and it seems that investors may be ready to jump back into the cruise line business. But before we go too far, I do want to bring a little bit of caution. One of the big reasons the stock was up so much this week is because a couple of analysts upgraded their price targets. The market will eventually forget about those price targets and will value a company like Carnival based on the fundamentals of the business. So that's what I want to focus on today. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And I want to start with a chart that has a lot of information in it. This includes Carnival's price, long-term debt, and enterprise value. This chart includes Carnival's stock price, which you can see is down sharply from peaking in late 2017, early 2018. It has long-term debt, which is that orange line, and then enterprise value, which is the blue line. Enterprise value is a measure of market capitalization, so the value of the stock, plus the value of the debt. So a company could have an enterprise value of $10 billion and have a stock worth $1 billion and debt worth $9 billion, or the exact opposite. And really the way to think about that is debt is more of a risk to the business because you have to pay interest on that debt. So the big takeaway here is that over the last few years, because of the pandemic and the shutdowns that were involved, Carnival has gone from about $10 billion worth of debt to about $35 billion worth of debt. That puts a lot of pressure on the business because now you have to fund that debt. And with interest rates rising, you're talking about potentially billions of dollars per year just in interest payments. So something to keep in mind here, Carnival's enterprise value, the value of the company overall, is already back to about its peak valuation. But what do operations look like? If we look at this is the chart showing revenue, operating income, and free cash flow. You can see that revenue is still not back to peak levels before the pandemic. As positive as it is that there has been more bookings over the last year or so, we really don't have an indication that we're going to get back to pre-pandemic levels of revenue, at least quite yet. So the market is a forward-looking mechanism. They are projecting growth, but I'm not ready to say that we're back to where we were in those days, especially when you look at things like operating income and free cash flow, both over negative $3 billion. Again, Carnival has a ton of debt on the balance sheet already, and operations are burning cash. That cash burn may be declining, but that doesn't mean that the business is going to be churning out cash anytime soon. While the market may be cheering things like analyst upgrades and increased bookings, I think we need to take a step back and think about the risk profile for a company like Carnival. This is a far more risky stock than it was just a few years ago because of that added debt that I talked about earlier, the fact that that's going to come with high interest rates as interest rates are rising. And remember, this is still a high risk business. So you're not going to see interest rates in the future of 5, 6, 7%. Debt for Carnival is going to be probably in excess of 10% interest rates. That's a massive drag on the company. And with operations still not generating positive cash flow, there's going to continue to be pressure on the balance sheet. So honestly, this is one of those companies that I want to see it get back to a more sustainable point before even considering investing in it. You could see from the chart earlier that the stock has actually rebounded and dropped a number of times since the pandemic began. And we're actually not that far from the pandemic lows. So investors that were buying, assuming there was going to be some sort of recovery, have actually been fairly disappointed because the stock has been so volatile, and gains like we've had over the last couple of weeks typically are given back over the next couple of months. So I would caution investors getting too bullish on Carnival until we actually start to see positive cash flow, start to see that debt level come down, because at the end of the day, there's just not any money left over for investors right now. Well, what do you think about Carnival? Leave your comments in the comment section below. Don't forget to follow Asymmetric Investing. Thanks for watching, everybody. See you here next time.